Hi everyone. So welcome to the discussion for our problem set 2. So as you can see naman from all of the items that you were able to answer, it's really focusing on completing the accounting cycle. Particularly our focus would be in terms of the recording process. So in terms of like all of the exercises that you've encountered, the foundation for it would really revolve around, two things. So one would be our foundational understanding between debits and credits. And second would be really mastering the different journal entries. So in the first part, it's just really more of your simple journal entries. And then in the latter part, it's really more about focusing in terms of your adjusting entries as well. So with that said, we're gonna be using the exercises as our foundation in terms of the overall review of our recording process. So we have a lot of exercises, but generally the things or the insights that I want you to crystallize would be the following. So number one, you have to master, or it should come second nature for you to already know the debits and the credits of each of the accounts. So again, in terms of important definition, accounts are just basically an individual accounting record that tracks the increases and the decreases in a specific asset, liability, or equity accounts that you may have. And in order to do this, we always use T accounts in terms of posting or summarizing the results for transactions. So again, debit will only mean left and credit would only mean right. And it will depend on their normal accounts on whether that would mean an increase or a decrease. But the important thing is that regardless of whatever exercise, whatever problem, I need you to be able to tell me what would be the beginning balance of an account, what would be the ending balance of an account, and what would be the changes in the account due to the different transactions. And to help you with that should be the mastery of creating your T accounts for each of the accounts. And then the general concept would be for every journal entry and for every reporting period, the general consensus should be that your debits should always equal to your credits in the same way that your assets will be equal to your liabilities and equity. So debits would always equal to your credits. And this is where we tried to crystallize that, okay, maybe we can reformat our expanded accounting equation, move to the left all of the negative ones, and then come up with this master copy for us. That in terms of like the ones on the left, they are the ones that have a normal balance of a debit, namely your assets, your expenses, and your owner's drawings. And then the ones on the right would be your liabilities, owner's capital, and revenue. Honestly, it takes a lot of practice and mastery for you to be able to treat this as second nature. So my suggestion would be, in preparation for your quiz, to redo the problem set as many times as possible so that it comes second nature already to you. Another way of looking at it would be if we didn't reformat our expanded asset um, equation. So this would be your normal equation, right? So debit and then lahat credit. But then notice that this is a negative number and then this is a negative number as well. So therefore, this is a contra account. So rather than credit, this will be a debit and this will be a debit. So again, different ways of looking at it, but the same insight. Assets, expenses, and owner's drawings are the ones that have a normal debit account. So with that said, the BE 2.1 is just really more about practicing what would be the normal balance and whether it would be debit or credit. So in order to assist this, I created the numeracy accounts and then we identify the component, whether it would be an asset or a liability, and then we determine the normal balance, right? So first would be in terms of our notes payable, right? So notes payable is a liability and therefore its normal balance would be a credit. Therefore, the debit would decrease this and the credit will increase a notes payable. Next would be rent expense. Rent expense would be under expenses. And like what we mentioned, the normal balance of a rent expense would be a debit. So if it follows debit, it's an increase, and then credit would be a decrease. On the other hand, revenue would be the opposite of expenses. The normal balance for sales revenue or revenue in general would be a credit. So therefore, debit decreases sales revenue and credit increases sales revenue. The last three would be equipment. So equipment is a asset. So if it's an asset, then the normal balance would be a debit. So debit increase, credit decrease. Owner's capital will have a normal credit account, as you may know, and therefore debit will decrease this and credit will increase this. And then finally, owner's drawings is the complete opposite of owner's capital, and therefore that would be a debit. So debit should increase and credit would decrease. So with that said, for 2.1, it's just really more about practicing the idea that assets, expenses, and owner's drawings have a normal debit account, while liabilities, owner's capital, and revenue have a normal credit account. So with that said, the next thing would be to master our journal entries, right? So in terms of the steps in the recording, we know that it's to analyze the transactions, to journalize the entries, and then post to ledger accounts. So communicating our financial statements. So with that said, we use the advanced transaction analysis from before, and then we're steering away from this level 1 analysis and turning it into a journal entry on a per transaction basis. And then after all of the 12 transactions, to summarize its effects vertically through the account ledger or your T accounts, right? So again, per transaction, you create a journal entry and then you eventually post them into T accounts. So in terms of creating the journal entry, we remember that per transaction, there's one journal entry, and we always follow our double entry accounting system that your debits should always equal your credits. So regardless if it's a simple journal entry or a compound journal entry, make sure that it's balanced every time. So to start off, we have a very simple example in D Castro. So D Castro has the following transactions. So first is open a bar consulting agency and invest in 450,000. So we bring this table out just for illustrative purposes. We know that since you invested cash, that would be an increase of 450 for both cash and owner's capital. So we then create our T accounts. T account for cash, T account for owner's capital. The normal balance of an asset, like such as cash would be a debit. Therefore, the 450 cash would be a debit. On the other hand, the normal balance of an owner's capital would be credit. So therefore, an increase would be a credit of 450,000. Now that we know, we just transfer to a journal entry. Debit cash of 450,000, credit owner's equity or owner's capital of 450,000. Next, we pay rent in advance for 6 months of 300,000 in cash. So now that we know the concept of prepaid assets, we know that we lost 300,000, but in exchange, we gained an asset called prepaid rent in the form of 300,000. So now we create our T accounts. So our cash and our prepaid expenses, right? So now we know that there is a decrease in terms of your cash, and that would be a credit on cash. While there is an increase in prepaid rent, which is an asset, so an asset has a debit, so that would be debit prepaid rent. And therefore, translating this into a journal entry would be debit prepaid rent, credit cash of 300,000. The next would be we receive 120,000 from clients for our services. So this one's silent. So if it's silent, the normal assumption would be we received it in cash. If there's no explicit mention of on account, then we assume that this is cash. So our revenues increase by 120, our cash increases by 120,000. So again, cash we already know, an increase would be a debit, while on the revenue, they have a normal credit account. So an increase in revenue would be a credit. So therefore, the journal entry here would be debit cash credit service revenue of 120,000. Number 4 would be pay 20,000 cash for their utilities. So this is a straight out expense. So we have a utilities expense of 20,000. So that's an increase in the expense and a decrease in the cash. So cash will have a credit for cash, but a debit for expense since it decreased. And therefore, it's debit utilities expense, credit cash for 20,000. So with that, we're done with our 4 journal entries for our BE 2.5. So these would be the correct answers for your notes. The next question that I wanted to answer would be, okay, we're kind of good at creating our journal entries. We kind of understand how everything relates together from a T account all the way to analyzing what would be the effects in terms of increases and decreases. So therefore, the next challenge would be to level up from level 1 transaction analysis to level 2. So now the focus of the next exercises would be talking about creating your T accounts and making sure that you understand how to create your trial balance. And if there is one major problem that I wanted you to focus on out of the problem set, this would be one out of the two. So this would be high rule services that have around 12 transactions that we have to take into account and the following chart of accounts. So the three things that we need to do is to create our journal entry, to create our trial balance, and then in terms of our income statement and statement of financial position. So for this, in terms of requirement, it would be a great bonus for you to add the different statements. But if you just opt to decide to create the journal entries and the trial balance, that should suffice as the proper submission. So same with what we did before, we're gonna be taking it on a per transaction basis, and then we're gonna be creating different journal entries. So number one, we invested 40,000 cash. So by now, this should be very obvious that this would be debit cash, 40,000, and then Arshaw capital or owner's capital of 40,000. So sometimes you'll see that there are names in terms of the capital, but this is just synonymous to owner's capital. I wouldn't be strict in terms of usage, right? So debit, cash, 40,000. Credit, Arshaw capital. Next would be we hired 2 employees, and the idea is that they will each be paid a salary of 3,050 per month. So one of the things that we have to remember going back to lecture 1 would be that we only track those that have economic effects. So it didn't say that they paid them 3,050, nor that there's an obligation due. It's just basically stating how much their salary is per month. And therefore, this is a more of a personal event or a non-economic event. And therefore, no entry, there's no liability, no expense. So kindly take note in terms of number 2. Number 3 is that we signed a 2-year rental agreement on a warehouse. So this is a classic phrasing for prepaid the rent. So now we will create debit prepaid rent of the 24,000 that we paid in advance, credit cash for 24,000. Number 4 is we purchase furniture and equipment. So in terms of how we paid for it, there's 2 ways. A portion of it was paid in cash, so that would be a credit in cash. And a portion of it became our liability or our accounts payable, so that's an increase. So in terms of the journal entry, of course, the first thing that we recognize is that our equipment increased. So that would be debit equipment of 30,000. The next thing is that our cash decreased. Therefore, that would be a credit of cash of 10,000. And then lastly, our accounts payable or liability increased. And therefore, the remaining would be a credit of 20,000. Number 5 is more about our insurance policy. So as you can note that it's a 1-year insurance policy. So there is a future economic event. And therefore, this would fall under the idea of a prepaid asset, particularly prepaid insurance worth 1,800. And therefore, since we paid it in cash, that would be credit cash of 1,800. Number 6 is just that we bought office supplies. So therefore, this would be straightforward. Increase in asset of office supplies, debit of 420. Credit cash, so that's a decrease of 420. Number 7 is that we purchase more office supplies, but this time, not in terms of cash, but in terms of a liability. So of course, it's still going to be a debit of office supplies of 1,500, but it will now be an increase of accounts payable as evidenced by a credit of 1,500 for our accounts payable. Number 8 would be in terms of our total revenues. So we're 20,000. So again, this is gonna connote a compound journal entry. So the things that we need to take into account would be number 1, our revenues increased, and therefore it would be a credit of service revenue of 20,000. But what would be the 2 different accounts affected? One is an increase in cash, so that would be debit cash of 8,000. And since it's on account, that would be an increase for your accounts receivable. So therefore, that would be debit accounts receivable of 12,000. Number 9 would be we finally paid some of our accounts payable in terms of our obligation for the supplies. That was previously mentioned. And therefore, knee-jerk reaction would be our accounts payable would go down. So that would be debit accounts payable And of course, we paid in cash, so credit cash of 400. So debit AP, credit cash of 400. And then last three would be in number 10, receive 3,000 from customers. So basically, our accounts receivable went down. So that's a credit accounts receivable. But we received cash. So that would be debit cash. And therefore, our journal entry would be debit cash, credit accounts receivable for the 3,000 amount. Next would be number 11. So it's more about getting our utility bills. So therefore, this is already an expense that we've already consummated during the month. And therefore, what we need to do would be to debit utilities expense. But since we haven't paid in cash and we're just still gonna be paying it next month, that would be in the form of a liability. And therefore, an increase in liability would be credit AP. And therefore, our journal entry would be debit utilities expense, credit accounts payable of $380. And finally, this is where the Pura and the other employee will come into play. So now we actually will pay them. So that would be salaries expense for the month of 6,100, and we paid them 6,100 in cash. By doing it properly, you will arrive with 11 journal entries. And the next step would be to post this to the different accounts. So like what I mentioned, the earlier or the better format would be every time you make a journal entry, you update your T account. So it would look as follows. First is we go to journal entry 1. So we create our cash and our owner's capital, transfer our debits and our credits. Then we go to journal entry 2. So we introduce prepaid rent, and then debit prepaid rent, credit cash. And then journal entry 3, we'll have equipment and accounts payable as the new entries. So we'll have debit equipment, credit cash, credit AP. Journal entry 4 will have prepaid insurance as the new T account, and then debit prepaid insurance, credit cash. Journal entry 5 will have office supplies. So we'll have debit office supplies, credit cash. 6 would be just debiting office supplies again and crediting accounts payable. 7 will have our new account, which would be our accounts receivable and our service revenue. And then just basically posting the debit cash of 8,000, the debit AR of 12,000, and the credit of service revenue. 8 would be just debiting accounts payable. So that's a decrease in accounts payable. Crediting our cash. Journal entry 9 will just debit cash again and credit accounts receivable. So this credit will signify that a portion of the accounts receivable have decreased. And then the last two would be introducing our utilities expense. So debit utilities expense of 380, credit AP of 380. And our salaries expense, so debit salaries expense, credit cash. And by doing this properly, we'll be able to get their subtotals, right? So subtotal, the debits and the credits for our cash. So 51,000 minus 42,720 will give us a debit of 8,280 for cash, a credit of 40,000 owner's capital, a debit of 24,000 for prepaid rent, a debit of 30,000 for equipment, and then we get the subtotals for AP of 400 versus 21,800. So 21,880, the bigger number, minus 400, will give you a credit of 21,480. And then debit for prepaid insurance, debit for office supplies of 1,920. Our accounts receivable of 12, we subtract by 3,000. So we'll have a debit of AR of 9,000. Our service revenue would be credit of 20,000. And then our expenses would be debit 380 and debit 6,100. So now that we're done creating our T accounts, the next step would be to double check whether the debits will equal to credits through the help of our trial balance. So kindly note that similarly to our financial position, our trial balance is in the form of an as of a specific period of time. And therefore, we create our trial balance. So the trial balance will just have 3 columns, your accounts, your debits, and your credits, the name of the company, trial balance, and then as of September 30, 2022. Next step would be we will list all our assets. So cash of 820, AR of 9,000, office supplies of 1,920, prepaid insurance of 1,800, prepaid rent of 24,000, equipment of 30,000. So that's the first step in your trial balance. We list all our assets in order of liquidity, right? So cash first and then equipment last. Next would be in terms of our liabilities. So we have our accounts payable, and that would be it. The next would be list our OC and OD. So owner's capital would be 40,000. And we have no drawings. So we don't have any drawings. And then next would be revenues. So revenues would be again a credit. And then our expenses would finally go last as debits. We subtotal everything. That would be 81,480 for debits and 81,480 for credits. And therefore, we've finished our trial balance. So for appreciation, we're just gonna be turning this trial balance into our income statement, our changes in equity, and our balance sheet. So for income statement, we already know revenues, expenses, net income, or net loss. So basically, step one is we get our total revenues. So that's just basically service revenues. And then we get our total expenses in order of magnitude. So that would be salaries expense and utilities expense. So 20,000 revenues minus 6,480 total expenses will give us a total net income of 13,520. We will now use this in terms of using our changes in equity, right? So again, our beginning capital would be 0 because the agency or the Hyrule services just started. Then add any investments. So the investments would be 40,000. And then our net income of 13,520 that we got from our income statement. So we will have 53,520. We don't have any owner's drawings. And therefore, ending capital would be 53,520. And then finally, our financial position would be, again, total assets versus total liabilities plus equity. So we start off with our assets first. So we get our cash, our AR. It will give us a total assets of 75,000. Our liabilities will be 21,480, which is basically our accounts payable only. And our owner's capital, which we got from our changes in owner's equity, would be 53,520. And therefore, when you total 21,480 and 53,520, that will be 75,000. So basically, by using our trial balance, we were able to create our income statement, our changes in equity, in our statement of financial position. So the trial balance is basically your updated form of your advanced transaction analysis. Basically, the subtotals of your debits and the credits for your ending balances for each of these following accounts. So just last things in terms of theory. So again, kindly remember that journal entry is just basically the formal entry of a transaction to a journal, while an account ledger is just basically the formal version of your T accounts. And it works that account ledgers will happen for each of the accounts, right? And then trial balance, again, like what we mentioned, it's optional, but what it does is that it lists accounts and balances at a specific point in time. So that's something that we definitely would want to create. So therefore, in essence, trial balance would be, it's all about creating debits or making sure that your debits equal to your credits. So again, with your trial balance, you can get your income statement by looking at your revenues and your expenses. You can get your changes in equity by looking at your owner's capital and owner's drawings. And then you can get your balance sheet by using the asset and the liabilities portion. So basically, that would be halfway of basically what we want to achieve in terms of adjusting the accounts and also in terms of just the recording process, right? So that would be in terms of two things. So knowing how to create your journal entries and also knowing how to post and create your trial balance. The second part in terms of the recording process would be understanding two different special entries. So particularly or adjusting entries and our closing entries, right? So in terms of the theory for adjusting entries, again, let's just go back that number one, adjusting entries are required. So they are required. And what they do is that they ensure that revenue and expense recognition principles are followed by the company. So they're usually made on the last day of an accounting period. So again, these are just some of the reasons why trial balances may not contain up-to-date information. So sometimes it's too time consuming or it might be costly, or sometimes some items may be unrecorded. And therefore, we introduce are two types of adjusting entries: our deferrals, which will be our prepayments or our cash now, right? And our accruals, our incurrences, or cash later, right? So under deferrals, you have two. You have your unearned revenue and your prepaid expenses. And then under accruals, you'll have your accrued revenues and your accrued expenses, right? So as a review, let's just go through the different deferrals. So deferrals, again, are your prepayments. And one of the examples would be your prepaid expenses. So you have your supplies, your prepaid rent, and your equipment. On the other hand, you'll also have your unearned revenue. So that would be when you receive cash initially, but then at a later date, you will then recognize a revenue. So in general, that would be your deferrals, your prepaid expenses, and your unearned revenue. The next would be your accruals or your incurrences. So you'll have your accrued revenues and your accrued expenses in the form of interest or even salaries. And basically, the idea is that our revenue would be your accrued revenues, so cash later, wherein we recognize expenses and revenues, wherein there are no cash components yet that have been affected. So now the question is, let's test our mastery. And the idea behind Edge Runners Inc. was to test our mastery in terms of our type of adjustment and our accounts before adjustment, and also the adjusting entries that we'll need. So first would be, out of the 6-month prepaid rent for their space in Night City, the company has realized 1 month worth of rent worth 30,000. So the idea here is, the first question is, you ask yourself, what is this? And obviously, this is a prepaid rent or a prepaid asset. And what's really happening is that now what we're doing is we're paying cash. And then later, so when we pay in cash, that would be an asset. And then eventually, we'll recognize a portion to each of the expense as we consume them. And therefore, the next question would be, this is a deferral or a prepayment specifically for prepaid assets. So the type of adjustments that we're going to be doing would be what? When it's a prepaid expense, what happens is that after 1 month, your assets will be overstated, right? And your expenses will be understated because now you have to recognize 1 month's worth of rent. So therefore, what we have to do is debit expense, credit asset, right? So we have to increase the understated expense, and we have to decrease the overstated asset. And therefore, our adjusting journal entry would be debit rent expense, credit prepaid rent of 30,000. So this is the answer to number 1. Number 2 would be an example of our salaries payable, right? So the thing that we need to the first question is, if you're having a hard time with accruals and deferrals, the first question you ask would be step 1, cash now or cash later analysis. So now what's happening is that, did we pay cash now? No. What we did was we recognized the expense and then we'll pay cash in another period. So is it a deferral or an accrual? Well, obviously, it would be a accrual, incurred, accrual, cash later. Specifically, what type of accrual? It's a accrued expense. And what usually happens under accrued expense is that if you do not recognize this expense, what will happen would be that your expense will be understated and your liabilities would be understated. And therefore, our adjusting entry would be to increase our expense that has been understated. So that's a debit expense. And then to increase our understated liability. So that would be a credit. So debit expense, credit liabilities, or specifically, debit salaries expense of 45,000 because there are 2 people. So 22,500 times 2. Credit salaries payable of 45,000. Number 3 would be in terms of cyber installations performed, totaling 460,000 are unbilled. So again, step 1, cash now or cash later. Meron ba tayo natanggap na cash? No. And therefore, what we're doing is, right now, we're recognizing a revenue, but we will receive the cash later. So similar to number 2, this is a classic example of an accrual, wherein it's the incurrence or occurrence of revenue and expense that comes first. Specifically, unlike number 2, this is a accrued revenue. And therefore, what do we need to do? What happens if we do not record this adjusting entry? Well, before the adjustment, what will happen is that our revenues will be understated and our assets will be understated. So to correct this, the needed adjusting entry would be something that goes like this. First is we need to increase our understated asset by debiting an asset. And therefore, the next thing is to increase our revenues by debiting our credit as well. So that's something that we'll definitely be doing in terms of our adjusting entry. And specifically for this, that would be debit AR of 460,000, credit service revenue of 460,000. Number 4 is that we previously collected 240,000 cash advance for installation services. And then we finally completed the service. So what happened? So step 1, cash now or cash later, we received the cash at the start. So therefore, that would be cash now, and then we'll recognize the revenue later, right? And therefore, this would be an example of a deferral. And what particular deferral? That would be unearned revenue. And if we do not recognize that we've already received the revenue, what will happen is that we will have a overstated liability of unearned revenue kasi we still treat it as a liability. And we have an understated revenue, right? Account. And therefore, our adjusting entry for these types of unearned revenue would be what? We need to decrease the overstated liability by debiting a liability account. And then we need to increase the understated revenue by debiting a revenue account. And therefore, that would be debit unearned service revenue of 240,000, credit service revenue of 240,000. So now that's what we're doing. We're recognizing the revenue by adjusting the entry. Number 5 would be electricity expense of 2077 are unpaid. So obviously, this is a cash later. So we recognize the expense now. We need to pay the cash later. This is an example of a accrual, specifically a accrued expense. So that would be similar to number 2, I think. We will have an understated liability and expense if we do not record the adjusting entry. And therefore, we need to debit expense and credit liability to overcome these understatements. And the official answer for this would be debit utilities expense, credit accounts payable for 2077. So a lot of you were looking for utilities payable. That would still be a valid answer. But if wala kayo mahanap na salaries payable, utilities payable, for now, the blanket that you can use would be accounts payable as well. And then finally, number 6, tech supplies of 3,600 have been used. So this is basically we paid in cash, but we'll now recognize the expenses of the supplies consumed. So this would be a deferral, particularly in terms of prepaid expenses in the form of supplies. So therefore, what we need to do is to recognize an expense to overcome the understated expense and to minimize our overstated asset. So that would be debit supplies expense of 3,600, credit supplies of 3,600. So this would be our major answer for problem 3.1, which would be your edge runners problem, right? So this is the type of adjustments, your accounts that are before adjustment and therefore necessitated the use of our adjusting entries. So again, that's just basically your quick overview for your deferrals and your accruals. So next would be in terms of our adjusted trial balance. So now we're stepping in from level 1. We already did level 2 earlier, and now we're gonna go into the avenue of level 3. And again, like what we mentioned, we had that case study in terms of body consulting that we know that adjusting entries happen at the last day of period. So we create our adjusting entries and then we update our unadjusted trial balance by creating or applying the effects of our different adjusting entries. So to practice or to master the process, this is the second out of the problem set that you should focus on, which should be your summoning salt exercise. So what we need to do is to journalize in the post our adjusted recording process roadmap. So step 1 is to create our journal entries, right? So identify what kind of accrual this is. So this is a prepaid insurance. And we need to understand the initial entry. So at the start, basically what happened is that our journal entry 1 is that we had a prepaid insurance of 1,800 in cash. So at the start, it was purely considered an asset because on June 1, we haven't consumed any portion of our insurance. The next step is so that we can compute for the consumption or earning to be recognized. So in terms of the 1,800, we have to understand that we need to break it down per month. So 1,800 divided by 12 is that every month we're consuming 150 insurance expense out of that particular plan. So times the 7 months. So how did I arrive with 7? June 1, June 1, July, August, September, October, November. So 7. So pag June 1, it's 7 months. So times 7 is 1,050. And therefore, what happens is that this 1,800, you can now break down into two. A portion of it that have been completely consumed by expense, so this is 7 months worth, and the remaining 5 months worth of assets. And therefore, to account for this expense occurring, we need to create our adjusting entry. So we have to recognize 1,050 worth of expense while lowering the asset for prepaid insurance. So our adjusting entry would be, we need to recognize a debit of insurance expense of 1,050 and a credit of prepaid insurance of 1,050. So that would be our adjusting journal entry number 1. Number 2 would be we secured 5 months rent in advance. So this is prepaid rent and paid 6,500 on September 1. So at the start, we debited 6,500 prepaid rent, credit cash. So at the start, it was purely an asset because we haven't consumed any of the 5 months of rent. And that happened in September 1. So now, what date is it today? It's the end of the reporting period. So how many months from September 1 to December 31? September, October, November, December. So what happened is that we consumed 4 out of the 5 months of rent. So how do you get the amount of rent expense that we actually consumed? What we do is, step 1, get the amount paid, so 6,500. And then you ask yourself, for how many months are we covered for this? Well, technically, you're covered for 5 total months. And therefore, 6,500 divided by 5 months is that, as expected, you're consuming 1,300 rent expense per month. But again, from September to December, how many have you consumed? September, October, November, December. 4 months. So 1,300 times 4 is therefore we've consummated 5,200 worth of rent expense. And therefore, what will happen will be that the 6,500 will be broken down into 5. 4 months that have already been expensed, so 1,300, so that's 5,200. And the remaining 1,300 remaining asset that is still unconsumed. So this represents the rent from January. And therefore, our adjusting entry would be debit rent expense 5,200, credit prepaid rent 5,200. So we subtract a portion of the asset and attribute it to expense. Number 3 would be we received 3,600 cash in advance. So basically, that's in total for 9 videos to entertain its subscribers, right? So that's unearned revenue, right? So our initial entry would be, yes, we received cash, but then technically, that's a liability called unearned service revenue of credit of 3,600. The next part would be we understand the initial entry. So right now, it's purely liability. 3,600. The cash that we receive is purely liability because we have an obligation to perform a total of 9 months for this. So what we do is that, okay, we receive cash 3,600. The months that are covered are 9 months. So technically, we're earning $400 per month. That is the service revenue that we need to recognize per month. Now, there are 4 months from when we got the money all the way till the end of the period. So 400 times 4, that would be 1,600. And therefore, we break this down again. So you have your 4 months of revenue, and then you have your remaining 5 months of revenue, unearned service revenue, right? So therefore, this is what we'll adjust. We'll need to recognize this revenue consumed. So it's not purely liabilities anymore. A portion should be recognized as revenue. And therefore, our adjusting entry would be debit unearned service revenue of 1,600. So subtracting the portion of liability and recognizing that they have finally become part of our service revenue. So debit USR, credit service revenue of 1,600. Number 4 would be we signed a contract for laptop maintenance service. So this is what kind of accrual? This is prepaid cleaning, right? We paid already in advance. So that would be debit prepaid cleaning of 2,000, credit cash. We got it on November 30. So we only have, so November, be careful. There's a difference between November 1 and November 30. November 30 means that you are consumed 1 month, right? So how do we tell or how do we break down this asset? So 2,000 we paid in cash for 2 months worth of cleaning. So technically, we should recognize a cleaning expense of 1,000 per month. How many months have expired? Well, basically, we're just looking at December. And therefore, 1,000 out of the 2,000 should be recognized as cleaning expense. So expense for 1 month, the month of December. And then we still have an asset because this would be the prepaid cleaning that will be consumed on January of next year. Therefore, our adjusting entry would be debit maintenance expense 1,000, credit prepaid cleaning of 1,000. And then finally, number 5, on December 5, we received 1,500 in advance from Matter.co, and that 475 of these videos have not yet been released. And therefore, this is again unearned revenue. So again, it would be debit cash, credit unearned service revenues 1,500. So in total, since we haven't given them any of the videos or we haven't released any of the videos, it's purely an obligation. But now at the end of the period, it clearly states that 475 have not yet been released. So therefore, 475 is our remaining obligation. The rest, we were actually able to earn as revenue, right? So one way of looking at it is we receive 1,500. That was purely an obligation. But now, only 475 remains unearned out of that service revenue. And therefore, 1,025 would be our earned revenue. And therefore, our service revenue would be 1,025, and then the remaining unearned would be the 475 liability. So therefore, we make our adjusting entry here to uphold our revenue recognition principle. So that would be to minimize our USR, so debit USR of 1,025, credit service revenue of 1,025. So at this point, we were able to create 10 journal entries. 10 initial entries, and then, 5 initial entries, 5 adjusting entries. Right? So the next step is to post this to the T account. Right? So we'll have, in the problem, it was stated that there was a beginning balance of cash of 6,200. And then from there, we just basically post, right? So debit 1,800 prepaid insurance, credit cash. Debit prepaid rent, credit cash of 8,500, 6,500. Debit cash of 3,600, credit USR of 3,600. Debit prepaid cleaning of 2,000, credit cash. And then debit cash of 1,500, credit USR. And then as you notice, inuna muna natin yung initial entries because we post in chronological order. So the journal entries adjusting journal entries happen at the end of the period, right? So we go to the next batch. Debit. So after these 5 journal entries, an adjusted trial balance is created. So we create an adjusted trial balance. And then finally, we create our adjusting entries. Debit insurance expense, credit prepaid insurance of 1,050. Debit rent expense of 5,200, credit prepaid rent of 5,200. Debit unearned service revenue, credit service revenue of 1,600. Debit maintenance expense, credit prepaid cleaning of 1,000. And finally, debit unearned service revenue, credit service revenue of 1,025. And here, you will now have your updated balances for each of the accounts. Right? And therefore, this would be the basis of your unadjusted trial balance. So basically, what you're expecting is a debit in cash of 1,000, a debit of prepaid insurance of 750, a debit of prepaid rent of 1,300, a credit of unearned revenue of 2,475, a debit of prepaid cleaning of 1,000, a debit of insurance expense of 1,050, a debit of 5,200 rent expense, a credit of service revenue of 2,625, and a debit of maintenance expense of 1,000. So these all would be your adjusted balances. So with that, we're down to our last. So we're done with level 3. So the last step is let's close the books so that we can complete our accounting cycle. So again, closing the books happens at the end of the accounting period so that we can be ready for the next period and that the company closes our temporary accounts. So again, there's a difference. Your temporary accounts are those that you can find in your income statement and your changes in equity. So that would be your revenues, your expenses, and your owner's drawings. We all have to zero them out. In contrast, our permanent accounts or our real accounts that we can find in our financial possession, we don't close. So we retain our assets, we retain our liabilities, and we retain our owner's capital. So how do we close temporary accounts? So this is a new exercise similar to what we discussed from Padico, but this time this is the RR Sipaj company. So again, the idea is that technically we've been closing everything to the financial statement. So your revenues, your expenses, you close it out, you get your net income, right? Your net income, you then bring to our changes in owner's equity so that we can get our ending capital and owner's equity. And basically, lahat yan, owner's drawings, your net income, your net loss, will all be zeroed out so that we can transfer everything to the owner's capital, and this will be your permanent accounts, your assets, your liabilities, and your equity. So again, we first close our revenue accounts, we then close our expense accounts, we then close our net income to owner's capital, and then we close our owner's drawing to owner's capital so that at the end, ang matitira na lang would be your ending owner's capital. So to summarize, similar to adjusting entries, closing entries are required and they are usually made on the last day of the accounting period. So zero out your revenues, zero out your expenses, zero out your owner's drawing. So let's now close our revenue accounts using our Sipaj, right? So right now, it's just 12,800 in terms of service revenue. So in terms of our first adjusting entry, that would be a debit of 12,800 that we need to do to zero it out. So, but for illustrative purposes, let's just fill in or update both the T accounts of our expenses, right? So now that we've done that, the next step would be to know their balance. So right now, there is a credit balance for our revenues and a debit balance for expenses, their normal balances. So to zero them out, for revenues in particular, we need to introduce the idea of an income summary account. And what it does is it basically facilitates our closing process. So basically what we'll do is, to zero this out, we need a debit of 12,800. So the next question would be, saan mo i-credit? I-credit mo siya kay income summary. So we've achieved our goal of zeroing out revenue by introducing our income summary. So debit, revenue, 12,800, credit income summary. So that's the first closing entry. For expenses, it follows the same principle, but we will itemize. So basically, what we'll do is close 7,504 to income summary. So that would be credit 900 pero debit kay income summary. Credit 900, credit 250, credit 190, and credit 150. But all of it will be a debit to our income summary. So in total, we were able to zero out our expenses. So that would be debit to our income summary of 9,894. And then we have our different credits for our different expenses. And therefore, we will achieve our net income of 2,906. And therefore, it will be the same as our income statement. The next step is to close it to our changes in owner's capital, right? So how will that work? So we have our income summary, which represents our net income. And then our owner's drawings would be a debit. So it has a debit balance of 1,000. So this is the two T accounts that we have to zero out to our owner's capital. So we have our beginning of 18,700. So next step is we zero out our income summary. So to do that, we need a debit 2,906 and a credit owner's capital of 2,906 to zero it out. So our third journal entry would be debit income summary, right, of 2,906, credit owner's capital of 2,906. For owner's drawing, we do the opposite. To zero it out, we need a credit owner's drawings but a debit of owner's capital of 1,000. So our last journal entry would be debit RA capital, credit RA drawings of 1,000, right? And with that, we are able to arrive at 20,606, which would be our ending capital for RA, right? RA. And that would be reflected in our statement of financial position. And that's it, basically. That's our closing entries. So basically, memorize lang the process. Expect that if it's net loss, this would be a different scenario. So kindly take into account. But the general idea is we close our revenues to income summary and we close our expenses to income summary. We then close our income summary to owner's capital and then we close our owner's drawing to owner's capital. Right? So figuratively, what we did was we close our revenues, we close our expenses, we close our income summary to our owner's capital, and we close our owner's drawing. So lahat sila pumupunta kay owner's capital. And basically, by doing that, we're able to create our post-closing trial balance for our RCPAB. So again, they don't have revenues, they don't have expenses, and they don't have owner's drawings because those are temporary accounts and they have been zeroed out while your permanent accounts remain to be updated from period to period. And with that, we finally mastered our full accounting cycle from analyzing our business transactions to journalizing our entries to creating or posting to our ledger accounts or T accounts, to preparing our unadjusted trial balance, to knowing our two special entries or adjusting entries so that we can get an adjusted trial balance. And then we can have prepare our financial statements. And then the last two steps would be our closing entries and our post-closing our trial balance. So thank you so much, everyone, and good luck on your quiz on Tuesday. Thank you.